Good morning, everybody. It is Monday, January 24th, and we got a good old-fashioned butt whipping going here on the stock market. Looks like the S&P 500 is down, let's see here, over 100 points at the moment, 2.5%. The NASDAQ 100 looks like it's down, 65 points? Is that what that is? Oh, I take that back. That's the S&P 100. Let's see, NASDAQ 100, almost 400 points. So down 3%. So 2 to 3% down in the markets across the board. Small caps are actually down the least, but that makes a little bit of sense since they've been down the most for 11 months now. And, it was a long time coming. I'm surprised that the stock market didn't anticipate lower liquidity way earlier than it did. I think everybody wants to be a just-in-time investor, a just-in-time trader, and that lends itself to more extreme moves, up and down. Up moves take longer, down moves take shorter. So I wouldn't expect a 2-year bear market here, but I do think this could be a tough year, particularly if the Fed doesn't reverse course this year. Now, I originally didn't think the Fed would raise rates at all because I could see that the economy was starting to slow down in the second half of last year, that the V-shaped recovery essentially ended by Q4 of 2021, and that the inflation was peaking at that time and is finishing up with its peak right now. The only thing left that could really drive inflation up is, another spike in oil, but that would be short-lived. We got some good news on gasoline inventories and oil drawdowns being less than expected last week. So I think as the Permian starts to pump more, which we know is happening, and as OPEC is able to get more countries online and certain countries cheat, I think that, probably short of missiles flying in the Middle East, more than they normally do, you probably are going to start seeing the year-over-year comps in the second half of this year start to fall dramatically, which is what the Federal Reserve is saying, and that by next year, inflation will be in the 2 to 3% range again, which is what they're hoping for. I think they're going to get it. So in the meantime, we have people with their breathy narratives, with all their reasons why things happen, with certain people being real arrogant as to their magical formulas and why they would work. Certain people who said that this market would reverse back up at 4,400. I have learned in 25 years of doing this that arrogance and being tied to one way of thinking are often your biggest detriments. It's the same thing in life. People who are arrogant make mistakes. It happens at the poker table all the time. Happens in NFC playoff games, when maybe a quarterback is just too stubborn to listen to his coach, that he ends up, going 3 and out a bunch of times. And ultimately his punter's kick gets blocked, and how that goes. In any case, I will be wearing a 49ers shirt on Friday, so you'll get to see me wearing a 49ers shirt. I actually made the bet after the game. I just felt so bad about how the Packers played that I said I'd wear a 49ers shirt next Friday, or this coming Friday, presuming Amazon gets me the one that I want on time. In any case, arrogance is why people make mistakes. When somebody constantly tells you how much they know and why they understand things that you don't possibly have a chance to understand, and they're not a billionaire, and they're making most of their money on subscriptions, not on investing, well, then maybe you ought to take a step back and consider maybe some things don't rely on magical formulas or aliens. I'm writing an article today, going to have all my limit orders in, and I'm showing you why the market's going to come down. I also have this little quote from a guy named Warren Buffett. Investors should be skeptical of history-based models constructed by a nerdy-sounding priesthood using esoteric terms such as beta, gamma, sigma, and the like. These models tend to look impressive. Too often, though, investors forget to examine the assumptions behind the models. Beware of geeks bearing formulas. Now, back in the early 2000s, I was reading all about the turtle traders, some of the early traders. And if you ever watched the movie Trading Places, I believe it was, with Eddie Murphy, it is loosely based on the tribes of turtle traders and how they could be trained to become good traders. And that is an excellent point, is that you're not born a great trader. You just become a trader by trial and error and trying to learn what works. And here's what I've learned works. First of all, fundamentals work. In general, you do want to be in companies that are fundamentally strong, that they have good balance sheets, that they're growing EBITDA and free cash flow, which will fall to the bottom line as earnings and shareholder yield. Shareholder yield being debt reduction, dividends, share buybacks. What does Charlie Munger tell us? Buy the cannibals. Companies that eat their shares, reduce share count, typically do the best over time. It doesn't mean that sentiment can't drive a bad stock up or a good stock down. Often, though, the deciding factor is liquidity. And what I've learned, having been headhunted by some of the best firms in America back in the day when I thought I really wanted to move out east, is that they're all looking for people who can figure out how liquidity in the markets work. And while you can get that information on a chart, usually by using the right technical indicators and Elliott wave theory, the problem that I have discovered is that very often technical indicators reset or go to an alternate outcome when liquidity changes. So the big changes in liquidity are what drive sentiment. So it's not that sentiment speaks, it's that liquidity speaks and sentiment listens. So if we can measure liquidity, we can then understand what's coming with sentiment. We can understand it as it happens in real time. You even predict it a little bit. Now, my concern with the Federal Reserve is that they want to reload their bazooka so badly that they're going to overshoot on the tightening. And when you go on Bloomberg or CNBC or whatever it is you're watching, I recommend Bloomberg in so many ways. Don't get a nickel for saying that. What you learn, when you hear somebody talk about a potential Fed mistake, is that they're worried that the Fed's going to tighten too much. Because those of us who understand the economy truly at a macro level, we're not looking backwards, we're looking forwards, and we understand history when we look forward. We're not actually looking in the rearview mirror. We're looking forward, and we already know what certain things look like. And we know that certain big trends don't change overnight. Some big trends, like aging demographics, literally take generations to change. That's why slow growth forever is in the background of every single economic and investment decision, economic analysis and investment decision that you'll make the rest of your life. Demographics are destiny. And the reason that the Fed wants to reload its bazooka is because they know that the boomer bust isn't over with yet. There's one more kick in the entitlement junk coming. And depending on which academic study and which economic think tank you read, I like the Atlantic and a lot of the American universities, what you realize is that somewhere between 2026 and the early 2030s, we're going to really have to deal with Medicare being overwhelmed. And the way to get it to not be overwhelmed is actually to put everybody on it. Because then the risk pool, if you understand insurance, which is one of the major lessons you learn in economics, is we talk about insurance in those 301 and 302 levels, is the bigger the risk pool, the more efficient the pricing. And we can get to a point where we can win on the boomer bust. Will we? I don't know. We're kind of stupid that way. People who have opinions about things they don't understand. It's not just an American thing, it's an everywhere in the world thing. So what's going to happen next? What's going to happen next with our portfolios? And if you read some of these articles on the front page of Seeking Alpha, almost every single one of them is either wrong or they're talking about something that I talked about months ago. Like Mott here is pretty good. If you're not following Mott, you should follow Mott. He's a smart guy. He'll usually say what I said, about a month after I said it. I put up that overvaluation is the tinder under the stock market. You should read this. If these charts don't jump out at you as ripe for a change in sentiment that's driven by a change in liquidity, I don't know why you would handle your own money. Look, the most overvalued in history when you average 4 different indicators of valuation. Consider this trend line to be the mean and look how overvalued we are. Buffett indicator. It is literally a better idea to start a company than buy a stock. That's changing rapidly based on how fast the market's dropping. Returns after crashes. We've never seen returns after a crash this great. So after 1929, after the 2000.com, the 1973 going into the 1980, And what was the difference between this rebound from 2008 versus all the others? 2 letters, QE. The Fed literally printed money. And we can say they printed money because even though they generated debt, the idea that they'll repay all that debt is pretty low, pretty unlikely, right? So even when they started to roll back the Fed balance sheet a few years ago, they took barely anything off. Not increasing it is probably the best that we can expect. I didn't realize that this was popping up to be so small. But Berkshire Hathaway, Warren Buffett said eventually we'll get inflation from all the QE. Now, it took a whole lot more QE and a pandemic to create inflation. That should speak to just how strong the demographic factors are. That it took 13 years of QE, essentially, and a pandemic that destroyed supply chains because most of the world still isn't vaccinated, and the Saudis manipulating oil prices higher. It took a lot of things to create inflation, and those things are going to go away pretty quickly. I suspect the QE comes back. I think it's almost certain. If they could wait until the boomer bust in 4 or 5 years to do QE again, I would consider that a gigantic victory. One of the things to realize is that when you have a really long bull market, you'll typically get a bear market to follow. So from 2000 to 2009, U.S. stocks were actually flat. It was a lost decade. I would argue that a large portion of the stock market is going to experience something worse than a lost decade going forward. You're going to have big winners, but you're going to have equally big losers. And ultimately, I think from here until somewhere near the end of the decade, the S&P 500 doesn't go up all that much. But the tech indexes, some of the ETFs that I'm recommending, they'll do very well. Another way of looking at it from Hussman. Hussman's been a bear a long time and weirdly has been able to make money despite a raging bull market. That's the mark of a good manager, is you make money even if your big theme is wrong. I mean, Hussman is literally 2 decades early on the things that he was talking about. Unlike me, I'm 2 years early a lot of times, but got it to within a year lately, which I think people can stomach. But when you see what's coming, you get ready for those gigantic moves up or down. So while I got you heavy in cash a little early, up to a year early, I bet you feel pretty good about that now. Somebody mentions in the chat, Jeremy Grantham says there'll probably be a 50% correction. When we take a look at the charts, you can certainly see it. It wouldn't take much for this to get back down into here. I don't think it'll go all the way down here, but if it gets to the between 1 and 2 standard deviations of overvaluation, that in fact is over a 30% correction and would be approaching 50% down in here. So what do we want to do? We want to look for investments that have had great relative performance in the recent past and also are legitimately growing their earnings. No funny business with the balance sheet. So where we can find stocks that have been leaders recently that also have growing earnings, right? A strong thesis behind them, good fundamentals, secular trend at their back, government policy that's at least neutral to favorable. And we can catch them at a technical bottom or a quantitative bottom because liquidity stops going down. You're going to probably get some doubles and triples and quadruples pretty easily just by scaling in over the course of maybe a month coming up. Relative performance is driven by repeat success. Think that through. If a company has had a good stock and the company itself has been making more and more money, the stock will continue to do well. You take a look at a company like Netflix, which was kicking butt for a long time and now is down 35% in a week. And I warned you about Netflix way back in February or March. I said, about the same time that I wondered if we were at peak Amazon, how much more growth could they have? And my answer for Netflix was not much. Not with HBO Max and Disney, Paramount, and other M&A coming. Right? Netflix will be in that basket of the half a dozen or so streaming services you have, but almost everybody has it. So they have to rely on global growth, which is a lot slower. Remember I said Amazon. I wondered in here if we were at peak Amazon. And look where we are now. Shooter is saying at his current count, so this orange line is about where you're going to want to see it. And I think the bottom fishing would be down here, back to the high end of the 2020 levels. There's nothing saying that we can't get to the low end of the 2020 levels and start to sniff some 2018 business. I just think it's unlikely. I think that this giant group of buyers has moved up. That's typically what happens. So this volume-weighted demand for stocks, when the market is going down, lines will go out as people sell. When the market's going up, lines will come out, right, as people demand it more. So you see this bottom here and here, the selling, because it was coming down, got exhausted. And as it started to go up, people piled in because they didn't want to miss it. And then they let it ride. And now, see volume increased on selling. How do you know it's selling? Because the stock price didn't go up. This was people taking profits. Now you're getting some panic selling. And at some point, buyers, probably these people who sold up here, will buy it back. I like those bigger cycles. To me, those are easier position trades. You literally can double the market's return if you just do stuff like this. Now, if you can get all these little moves like Shooter just destroys, hey, you might be able to triple the market return or more. But remember, in a choppy market, you're not necessarily playing against the indexes. At that point, you're looking for absolute returns. So I will finish this, and I'm going to do a global trends report, and I'll incorporate Shooter into that. So over at Fundamental Trends, Shooter does a major markets ETF risk on, risk off report. I'm going to turn off his video because he's so much better looking than me. And I'm just going to let him talk about this. Shooter, I've asked to unmute you.
I am unmuted.
You are unmuted. All right. So you can see my screen, so I'll let you go through this. Now, if you haven't seen this on Fundamental Trends, you should. And I will be incorporating some of this, not much of it, only the longer term charts, not the swing trading charts, because that's Fundamental Trends exclusive. But he talks about how he makes his trades, the basics of Elliott waves, basic of retracement and patterns, so you get an education here. So Shooter, tell us about SP 500.
Well, the S&P 500, we got a little different look actually right now. I've got a live chart if you want to switch over to it.
Well, why don't we do that? Oh, let me get rid of that.
You see my screen?
Oh, now we do. I think it is. Everybody see a Shooter screen?
Hey, we got it to work. All right. Well, hey, let's just jump right into it. A little bit of a change. You know, I want to come up here and show levels where I see our big support and resistance, and, this is, we've faded down. So I think we're going into this broadening pattern. And, ultimately, it just should keep getting more extreme from my view, and until we tag major support. And I don't think that'll change until the Fed reverses policy. So we're going into a very volatile period. All right. So that's where I think Elliott Wave is just a fantastic tool, provided it doesn't morph too much in the counts. Like I've been seeing these counts fade quite a bit. And to be honest with you, this is my first experience in a bear market using the application that I'm using. So I'm seeing a little bit of a difference now versus other counter trends where they were a little more predictable. So I've jumped to a different look that I'm sort of working with. This is my current count. So I'm looking at probably a 417 low in SPY. Now, what I've adapted, sort of you have to adapt on the fly when something stops working. So, I've come in and I've added an overlay to my charts, which is a basic Bollinger Band with fibs, show where the standard deviations are, because there's only been a few periods of time in history where the SPY has crossed the third standard deviation and stayed there. You almost always get a bounce, but I would suspect that we get a bounce back towards the 8-day or potentially the 50-day here. And then we continue lower after that. So just like we stair-stepped up on the way up, I expect us to stair-step down. And so this is, to me, is the first push down. Then we'll bounce and then we'll reset and put in a 2 down here and then reset, bounce again, and possibly put in a 3.
Hey, Shooter, so can I ask a question?
Go.
So that's stair-stepping. That's typical of markets, but that is actually a kind of the fractal nature of Elliott Wave as well, correct?
Correct. Yeah. But, the ultimate, what I've come to recognize, and let me just flip out to another base chart and just, when you look at the longer term look of the SPY and your wave counts, you have motive waves, which are impulse, leaning diagonals or ending dials, and corrective legs. Now, what I've recognized over time, there are really 3 patterns to corrective waves. And I classify all the corrective patterns either as a zigzag, double zigzag, or a triple zigzag. And that is where my 3 drive concept came from, because the market steps down. So once we close below the 78.6, for example, at my first golden box here, I'm looking for continuation to my second box. Once we close below the 178.6, I'm looking for continuation to my third box. And that's a basic concept. So until it breaks back and closes above the 78.6, I'm still looking for a continuation, right? So let me jump over to the Qs real quick and take a look at that. So, I think we got a bottom coming in right about where we are. I'm not seeing too much of a difference on that look. On the monthly look, I think we're coming down right around here. So the 4. So I think the Qs will come out first when we come out, but there's a good possibility that it back tests this 161.8 first right here, even though I don't really have a corrective box on the bigger picture here. I just haven't drafted it out on this. Now, if I go to our harmonics that we have on the different time frames, it tends to imply that we still have some downside, or it's been met depending on what time frame you look at. I look at those for continuation patterns, and I'm just flipping through them because I haven't, outside of that look. And then we look at our support and resistance levels, very much like the SPY. So right now I have these speed lines laid out that are my main focus on the NASDAQ, because I do think there's a good trade for a bounce once the buyers come in. So the first objective would be a back test of this speed line, and then I think we'll break down again. So it would be fantastic if it tagged my speed line and then bounced there. Then I would, have a lot of conviction on that particular symbol at this point.
Can you explain to people what harmonics is real quick?
Well, harmonics is a pattern recognition form of, Elliott wave, really. It's using Fibonacci extension, retracements, and, it's a form of Elliott wave theory, but in a different look. And I'm just throwing harmonics up here so you can see what they look like. They give you the measurements, like a measured move is an example. So, if you look at your push on this leg up, so from this X to the C, the measured move should range between the 277 and the 136 move. So it depends on the time frame that you look at in those patterns, whether it gives you those same counts or not. And they break down, they have different patterns. So on the shorter time frames, you may have hit your quant move, so to speak. And then on the weekly, you may not have hit that quant move yet because you haven't even hit your first target. So your time frames are a little different in view. And that's actually the most difficult part about Elliott wave, is looking at your time frames, because sometimes you have confluence with different indicators and sometimes it's blank and you don't see them. So that's just sort of my take on it. And the way I look at Elliott wave, it sort of gives me the broader picture of where we are, in time frames. And, drawing in Dow theory to Elliott wave a little bit. And the reason the basics I look at, a lot of people don't really respect the tenets of Dow theory. One, because it's so old, and, it goes back to the origination of the Dow and what happened with the first stocks. But like, for example, all indices must be in the same direction to indicate a trend change, for example, an uptrend or a downtrend. And, when, Charles Dow first did the, Dow theory, he based it on the industrials in the S&P. We didn't really have the S&P, the NASDAQ, the Russells, or the Dow in those 4 different categories. So it's morphed a little bit from the original time. But if you take the internals of each of those indices, you should have those sector ETFs, as an example, all heading in one direction, whether it be in a bull market or a bear market. And, that is a good indicator of when we have a trend change. And this is the first time in a while where we've had all 4 indices down for more than 6 days. It's unusual that so we've seen a difference going back to the tenets of Dow theory. But, the Dow I look at for a lot of different reasons, because we have the longest history in the Dow. If you just go back, I'm going out to the monthly on our time frames, it's the oldest indice that's out there. Now this is just the ETF, so it doesn't reflect that period of time, but it actually goes back to, I think 66, where we actually can pull data without having to pull data from the European markets to get that picture from, 1898 range. So, in Elliott wave counts, we have to go back prior to when you have data to get accurate wave count, to reflect that entire time period.
All right, can you leave this chart up a second?
Say it again?
Can you leave that chart up a second?
Okay, let me backtrack for a second. 1 month?
All right.
Yes.
Okay, crowd. I'm asking the crowd here. See that lowest yellow golden box. I love that you call it a golden box. Makes me feel like I'm going to get rich.
That's exactly why I named it that way, bro.
The golden box.
Yeah.
What level is that at, folks? What area have I talked about on the charts for years as being the baseline of this market? No. What year period? That's right. 2014, 15, 16, that flat consolidation period. So sometimes you don't get an actual bear market. Sometimes you get a long-term consolidation. So from the end of, I think it was February of 2016, maybe, June of 2014 to February 2016, something like that. That flat period was people switching what they were in. And that was a big shift out of energy stocks and into technology stocks. And then you had your FOMO start, and we got the big rally into 2018 because everybody was selling volatility. Volatility crashed. And then in December of 2017, I warned everyone, hey, volatility is going to spike again. Looks like January, February, March, first quarter. And of course it did. And some of you did that trade with me where we bought VIX calls. And, you know, I only made like 40, 50% on that trade because I'm a scaredy cat and I have regulators. But some of you made 3, 4, 5, 600% on that trade. Now, Shooter's been doing some volatility trades over fundamental trends. And I think I might flirt with irritating the regulators if I feel good enough about it. You know, I have something to lose. But one of the advantages you have as a do-it-yourself investor is you don't have to follow the rules I follow, right? I pretty much have to be a long-only investor because I'm regulated unless I open a hedge fund, and then I can be short if I'm working only with accredited investors. But working with retail money, the rules I have to follow is that I basically have to be a long-only investor and doing things more exotic, like buying the grayscale Bitcoin trust or VIX ETF. I could probably buy them plain, but if I leverage them up with a call or a put, if I'm wrong and somebody complains, the regulator is going to just crawl so far up my ass, it's not going to be funny. But you can measure the risk you're willing to take and follow along with some of these trades. And I would anticipate that after the next relief rally, there'll probably be some good VIX trades again. I don't know how long this one's going to go. And maybe we'll just get an elevator drop here. I mean, that wouldn't be very typical, but it could happen. It does about once a decade happen that way. So I'm not really sure. But what I would suggest, and Shooter will go through this a little bit, is after we get whatever this drop is going to be, the next rebound will be a chance to lighten up again. So you can buy some ETFs. I think that's the easiest thing to do. If some of the stocks get oversold on the monthly, I'll let you know, and then you can buy those too. But I think that he's right. I think that we'll get a rebound rally, and then I think we'll get that last leg down because I think the Fed is probably not going to care too much if asset prices go down. I don't think they care. And I think they know what I know, which is that the millennials are out trading the boomers. Now, I know a lot of boomers on this call, so just accept that that's your competition now. It's not other boomers. If you're on this call, you're kicking the shit out of other boomers. You got to beat the millennials or ride with them. So I don't know if it was Shooter that said this or something else I read. Being a contrarian investor requires not that you're just contrarian, but you know when to be contrarian. Sometimes you have to go with the crowd. But I think that the millennials are going to outtrade the boomers here. I think they are going to short this market at some point, and that'll be that next drawdown, I guess would be the way to go. And somebody says millennials are going to make early mistakes too. Yeah, sure. You know, the know-nothings, the people who are just like hodling things because they're like, oh, you know, I'm just going to buy because it'll always go up because the Fed will always push it up. Yeah, I guess in the long term, that's true. In which case you're just a glorified indexer, which means that if the indexes chop along for 7 or 8 years, you're going to get almost nothing. But if you are actually one of the people who put the time into trading, which a lot of these people on Reddit and what's that goofy Discord, you know, if you're a Discord person or a Reddit person and you're really actually studying, I mean, those millennials are doing very well. So let's not throw all the millennials under the bus for not knowing things because they don't have experience. You have two groups of investors there. And what I would say is the group of good millennial investors is larger than the group of good boomer investors, especially at those ages. So just keep that in mind. Don't get offended. If you're hearing me, you're one of the better ones. It's your neighbor that sucks. So, all right. So Shooter, what are you Jerry Reagan for us now?
Honestly, I don't know. Just jumping right out at it. I mean, the way the market's playing out right here, I don't like the fact that it keeps bleeding lower. And like I'd mentioned earlier, I've not seen that in my work with Motive Wave. So I'm not exactly sure how I want to handle that go ahead.
Are you able to put a liquidity or volume weighted indicator like I have on the right hand side? Do you have that?
Yeah, I could put a TPO on there. I mean, it's a completely different look. Let me just go to a new chart and throw that up. So these are my same charts that I use for doing my weekly. And honestly, I don't want to rework those and kill it. So we'll just throw in
I would bet if you put some volume weighted stuff on there, things will start jumping out at you because you're smarter than I am.
Yeah. I mean, this is something that I use
fast myself. You agreed with that? I said, yeah. He's smart than me.
Yeah. But, honestly, no, I just found a niche, and it worked. And, I guess for that moment, I was smart enough to jump on it and figure out how to perfect it for me. That's a good thing. So it'll take a second to pull it up it's going to pull all the data. And right now it's just going to complain because I have a lot of things open, but I'll just chat with, the TPO is something that is viable, as far as a time frame that, and I've got mine customized for a much smaller time frame.
Right.
But once we look at to me, I actually like Bollinger Bands with a Keltner channel in between it better because it shows the squeezes more so than the volume itself. The volume shelves have not helped my trading as much as other indicators when I'm using Elliott Wave, and I think a lot of that has to do because if I see option volume in a certain area, I've developed my own triggers for these squeeze bands that I use. And ultimately, when we're oversold in momentum down here, which ultimately is a reflection of volume, and we start getting these bases down here, I'm waiting for my cross. And, so that's where I'm getting long, and I've broken it down so I see it on a much shorter time frame. I don't use the TPO or the volume like you're using it on the longer time frames because I think it's distorted when in relationship to Elliott Wave, because you either catch this bottom as a swing trader and catch this low as you're getting out of a bottom, or you're missing your trade.
The volume weighted in my Quanta B experience is an indicator of institutional and large investor buying. So for the retail trader who's doing the swing trades, I don't think it matters.
It does,
but you see the huge support where institutions and big guys will come in.
Yeah. Now I have sweeps that come in another service who I get an alert for. That, so I'm looking at those. But, I'm only looking for 5,000 contracts or more that are coming in. I don't really care about 1,500 or, somebody comes in and puts 100 lots on something, I want to know, because that's a big play. You start seeing $2.5 million bets on something, then I'm starting to look at why is it doing that, or why is, and then if it did come in, why did it move it?
Because somebody's cheating. Someone's cheating.
Yep.
Someone always knows.
Yep.
Cheaters.
Yeah.
Nancy Pelosi.
But, she's just, honestly, the reason I think the Senate bids have done well and, they beat the market, it's because they understand that there are these large contracts coming in. So they do have, it's really not insider information because most of the hearings to some extent are open. It's not, we just don't go into those hearings or we don't watch the videos. So it's not like the CEO tells his wife that, hey, we're buying ATVI, this week, and she tells her friend and then she goes and buys the options. That's a different type of insider trading. I think it should be regulated. I would rather just force them to do a nurse service in the Senate where they have to post out that they're talking about this company before the hearing and that they might be interested in buying stock in it. So we have a list. I'd rather get it that way. And then we all can trade it because, then it's back to the free market concept of, hey, if you see it and you can get in early, it's advantageous for you to buy it kind of thing. So, but let me just jump over to the VIX. That was the last thing I wanted to go over real quick because I use the VIX as a hedge, but at the same time I trade it. So, right now I'm looking for about 28.89. And then I've got this breakout line drawn. And then I have my resistance levels going up. If we break down, I don't think we get much above 50 at this point, just because of how it's acting. And on top of that, my counts are still distorted, but they're to the downside. So on this next retrace, I think we'll get a rally off of that. And whether or not that speed line holds up there versus breaking out, still is yet to be seen. But, that's pretty much what I'm looking at. I'm going to focus on very specific things here. I started about 3 weeks ago focusing on small boxes, $3 to $5 moves on the different setups that I was putting in. And the reason is I want to be conservative. I didn't want to be greedy and say, hey, we're going to move $20 or, even though I may see it in counts by focusing on those micro trades, that are, initially the first piece off is a 30 to 50% gain or better. And then the idea is to keep a piece on or roll a piece on it and maybe get 5 or 10% of the remaining contracts that may run a couple 100% and just hang on to them. Just like right now, I'm rolling into $30 calls. We started with common shares. First piece I put on with this leg was at 17.95 and then bought more at 18. And then we covered on that first push over $20 and rolled 25% of that gain. Now I do a large block when I buy common shares. And we had $20 strikes there. And we covered those about 21.57 and rolled 25% into this week's 25 calls. So now I have next week's $30 calls. So my assumption is we're going to continue, but I keep scaling back into something that works with a limited level of risk, but ultimately the trade from day one, it's up about 125% from where I started, from the base, entering in on common if I took each of those positions over time.
And how big was that trade for you as a percentage of your total portfolio?
Well,
like 1%?
Here's what I do. I take 5% of my gains and I've rolled it into what I call my risk account. And I've done that for 4 years. It's my largest account. I've never drawn any money out of it. I have a very deep pool there that I can continue to buy. And I have a very specific way that I, sort of look at the VIX. I have these setups and I do clean charts. I haven't been here. I got busy on other trades, so I wasn't focusing on my counts. But when I set up the VIX and I look at it, I'm looking for how it's reacting to the markets. And I have, a SPY tape in here because, I'm sort of, that really is solely how I use the VIX. I use the SPY as my gain. But what I'm looking for is, are we wanning or, are we getting these flushes? So these are my scale in points where I'm entering and I build as I go down in here. So when I start seeing a correction like this, obviously I've taken whatever profits I took on this trade or I'm looking to scale in once we start seeing this topping pattern. So, here I put a little piece on, added a little more, maybe I'm at 2% here, 3% here, a 5% here, 8% here. So by the time I get down 5 legs is pretty much how it works. I'm usually between 18 and 25% of that account in common shares. And the reason is because there's no cost for me to sit there. One of the problems with most hedges is you get these bleeds. So it costs you money every time you have to put something on. So, if the markets has this extended long, uptrend, how much capital would you have spent if you started here just running a 3% hedge on your portfolio? By the time you get up here, you've cut maybe 20% out of your gains to the upside just hedging. It's expensive. So what I've done is I've figured out a way to use common and then roll into VIX. So my risk capital is limited over an extended period of time. I'm just going to jump out to the which one? Maybe I was on the wrong one. Hold on a second. Yeah. So now I've got these levels laid out on my longer term chart because what I'm trying to get free insurance for is this event right here. So we have this huge drawdown. I want to have a decent position size in the VIX so it offsets any long positions that I have. But honestly, the way I trade, I tend to get heavy cash when I start running into those scenarios. When I start seeing topping patterns like this in the SPY, I'm already trimming and I'm reducing my exposure, and I'm rolling over to assets that I consider off risk, like for example, in commodity or in currencies that are trending in a different direction. So I start shifting my exposure away from equities. So I'm not exposed to that risk because I know a drawdown's coming. Just like, this is we have a 3 drive here, 1, 2, 3. I know a drawdown's coming. Here we look at this. We got a 3, but it gave us a 4. 1, 2, 3, and a 4. So the 3 drive to a top pattern, which I'm going to shout out to Dale Pinkert. He's my coach and mentor for a little over 3 years. And, he is actually the best 3 drive coach on the planet. I mean, the guy has been on the CME floor. I think it was 17 years he traded oil in the pit. And, he strictly trades commodities and currencies. And, he's a great guy. We spend a lot of time together just going over different things that he's learned over the years. He'll be my coach until he retires and doesn't trade anymore because he gives me a tell about the market that nobody else has been able to provide me. I mean, he really is a gem there. So, we do a weekly review on Saturdays, and he goes over his view of the markets more for me because I really don't trade currencies with him unless I get bored. I focus more on the equities and crypto because that's where I like to play. But, I'm trying to mitigate my risk here, and I'm trying to avoid these pushes down because it costs you money. But at the same time, I want to have that coverage. So the idea is I'm looking at these trend lines. In most circumstances, this second speed line is where we're going to go. Look at how many times we've tested and back tested that speed line pretty much all the way back in time. We're going back to 2018 here on this particular ticker. Now, before the VXX, I used the UVXY, and then that thing blew up. Actually, that was one of the 4 times I've actually lost money on this trade, or I got a drawdown, was because, they shut it down for a period of time and all of your options went to 0. You couldn't get out of them. So, there is a level of risk. So I try and stay in the options absolutely as short as possible. So when I get down to these bottoms like we have here, so we have this, this sort of noisy zones. It sort of tells you where your tops are. If you look at this noise that you get towards the tops, and then this is the true risk off event. These really even were noise, but I would suspect that we get one of these risk off events up around 175. I would think by the end of the second quarter, and worst case scenario by the third quarter in 2022. So I think we have a much bigger event coming, and I think it's on the horizon, only because if you look at just how I view Elliott Wave and how counts expand. So your first count is sort of this small. Your next count's a little bit bigger. So your third count is is going to be way up here.
That looks like an alligator.
Yeah, it does.
That looks like an alligator. What happens to alligators? What do alligators do?
Yeah, that is a huge play. I'll have something on for that. I don't know what, where, or how, but my thinking is how much time. My line is April 2022. So that's the line that I'm looking at. So that's what I got, bro.
All right. So 2 things, folks. I will clean up this video, get it posted before I go see my son put on a show at a local establishment. He's breaking into show business, and hopefully he's my third retirement plan. I would encourage everybody who wants to trade a shooter to do it the way he does it and actually open a trading account. So that way it's segregated. And just like when you're at the poker table or you're playing a game where you go out, you run out of money, then you really have to think about, do I want to put money back in here? But if you start with maybe 5% of your portfolio, move it into a separate account, you just duplicate an IRA and put 5% of your money over there or a non-qualified account, but have a separate trading account for a comfortable amount of money as you learn how to trade a shooter. And he'll discuss things like three drive technical setups and whatnot over time. He's got all kinds of explanations out there already linked in his articles. So just have a separate account. And just to close, if I offended anybody talking politics, just understand it'll probably be somebody else a different day because I'm kind of anti all that stuff. It's not just one group I don't like. I just don't like everybody. So in any case, jokes won't hurt us, right? We can make fun of somebody else a different time. Yeah, Shooter, thank you very much. And folks, if you haven't gone on to the YouTube page, I tell you what, I've been putting some effort into editing these downs, getting rid of the dead air, getting rid of my and like that one. I'll edit that out.
You said that 3 times.
I will. That's clearly a Wisconsin thing. And, these videos, I've got most of them down. Now, the interviews go a little longer. I mean, Sean Steinsmith and the Emeritus CEO, which I'll have that one done soon. They really gave us a lot of time. So watch this Bitcoin and cryptocurrency and NFT interview with Sean Steinsmith.
Stay light there still, guys, on crypto.
Yeah, but when the time comes, that's why I want you all to have an account that's funded, because I think it's honestly, I think that if we can catch a bottom in Bitcoin here, it might be a 3 or 4 or 500% gain over just a couple of years. So that's where I'm at on that. Ethereum.
The upside hasn't changed, not at all.
Yeah, we talk about the upside with Sean Steinsmith, and we talk about what if all the billionaires and corporations put just 1% of their money into Bitcoin.
Yep, it's huge.
Holy crap!
Yeah,
it's such a big number.
Yeah,
so
it is.
All right, everybody, have a good day, and don't panic buy and don't panic sell. Just have a process.
All right, have a great trading week, guys.
All right, take care, everybody.